wealthbranch.com.
I like to study failure, actually. My partner says all I want to know is where I'll die, so I'll never go there. And we want to see what has caused businesses to go bad, and the biggest thing that kills them is complacency. Warren Buffett at the Coca-Cola annual meeting, April 24th, 2013. Why perform company valuations? The Dean of Valuation, Ashwath Damodaran, has a great example in his course about why he performs company valuations. He states that he does it to fight the lemming in me. Additionally, he explains that valuing a business gives you a life vest.
That's all valuation is. Valuation gives you a life vest. It gives you something to hold on to when everybody else changes their mind and goes in the other direction. It's not going to stop you from doing really stupid things. If you really want to buy something, you're going to find a way to buy it. If you really want to sell something, you're going to find a way to sell it. Valuation slows the process down, gives your rational side a chance to mount an argument. That's why we do valuation.
Why do valuations fail? After going through Wealth Branch's courses, you should know how to value a company. However, let's review some of the ways valuations can be wrong. Professor Damodaran talks about some of the reasons why valuations fail.
The first is that valuation is simple. We choose to make it complex. The second is every valuation, even though it's about numbers, has a story, a narrative behind it. A good valuation is more about the story than about the numbers. And third, when valuations go bad, it's not because of the numbers. It's because of three big problems I see in valuation. The first is bias. You come in with preconceptions and they find their way into your valuation. The second is uncertainty. We're not very good about dealing with uncertainty. And the third is complexity. We live in a complex world with complex data and complex models, and sometimes that gets in the way of the simplicity that should be at the core of valuation.
Understanding your perception and preconceptions. When investing, pessimism is your friend, euphoria the enemy. Warren Buffett. When investing, perception is your unique way you see the world or how you determine the truth about a company. Preconceptions can distort your senses. Faulty preconceptions will cause you to be euphoric, overly pessimistic, find confirmation bias, or form an incorrect valuation. Mr. Damodaran explains why assumptions can be troublesome.
Let me actually go on and talk about what I call the Bermuda Triangle of valuation. The three big reasons why valuations fail. And it's not about the numbers, it's not about the models, it's not about the metrics. Here's the first and biggest problem in valuation. Most people, when they sit down to value a company or a business, already have a preconception of what they expect to see as the value. It's very difficult not to. We almost never start with a blank slate when you value a company. Everything you've read about the company, everything you know about the company is going to become part of that preconception. The great irony is the more you know about a company, the stronger those preconceptions are. And when those preconceptions get set, your valuation follows. So if I think a company is a great company, guess what? My valuation is going to deliver a high value. In fact, let me add to that proposition. You tell me who pays you to do a valuation and how much you get paid. I'll tell you which direction the bias is going to be and how much the bias is going to be. This is, I think, one of the fundamental rules in valuation. When I see a valuation cross my desk, before I look at the numbers and the assumptions, I ask two questions. Who did this valuation? Who paid them to do this valuation? Because your biases are going to be preset by what your mission is.
Valuations and numbers are just estimates. To do future predictions and DCF calculations, you need to have your own opinions and estimates. Warren Buffett has indicated in the past that investors shouldn't always trust financial forecasts, predictions, and estimates because it's usually not safe to listen to anyone who suggests they can predict financial markets, Warren states.
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? No. I mean, just go down the list.
No.
No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money. And he went broke a couple of times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments. And he did very well. It's an interesting history. But if you look at the whole history of them, you know, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
Remember, when doing a valuation, you won't get it exactly right. In a must-read article by Eric Rosenbaum titled, "As the Dow Tanks, Here is Warren Buffett on the Biggest Puzzle for Investors: Intrinsic Value of a Stock." Eric writes that you're going to have to discount the future, and you should expect to get it wrong. Expecting to get things wrong about future cash flow is why Berkshire places so much emphasis on investing in businesses that the buyer understands, and only buying the businesses at prices which are reasonable, low enough to withstand mistakes in the model's assumptions. If a business is complex or subject to constant change, we're not smart enough to predict future cash flows. Second, and equally important, we insist on a margin of safety in our purchase price. If we calculate the value of common stock to be only slightly higher than its price, we're not interested in buying. We believe this margin of safety principle, so strongly emphasized by Ben Graham, to be the cornerstone of investment success. Eric Rosenbaum. Professor Damodaran explains that investing is an art and not an exact science.
Second big misconception about valuation, that valuation is somehow a science. You know what feeds into this? You sit in front of computers with models and you enter numbers, and after a while you tell yourself, well, I'm being objective. All I'm doing is using numbers. Well, don't be deceived. Even though you might be using numbers, those numbers are estimates. And when you think about those estimates are going to come with a great deal of uncertainty, and uncertainty scares people. So when you do a valuation, one of the tests you ask yourself is, am I comfortable? Am I certain about these numbers? And especially if you come from a quantitative background, you're going to look at those numbers and say, well, I'm really uncomfortable. These numbers could be wrong. Well, guess what? They're always going to be wrong because you're forecasting the future. And one of the great ironies in valuation is the more uncomfortable you feel valuing a company, the greater the payoff to doing a valuation. That sounds strange, right? You're valuing a technology company with a lot of growth potential. You are going to be more uncomfortable than when you value a stable company where everything is pretty much set. But those technology companies with growth potential, those are exactly the companies where you should persevere. Make your best estimates. And remember that most people give up on these companies.
Keep it simple and avoid complexity. Remember, at the primary level, you're only trying to solve two things. What is a reasonable price, and will the earnings be higher in the future? Buffett keeps it simple and explains in a 1996 Berkshire Hathaway shareholders letter, your goal as an investor should simply be to purchase at a rational price a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Additionally, Professor Damodaran breaks down the nature of creating overly complicated models.
And here's the third misconception about valuation. If you make a model bigger, it's going to get better. And it's so easy to build big models now. As you build these big models in Excel or whatever your tool of choice is, remember you have to make those assumptions, those inputs that drive these models. And as these models get really complex, two things happen. One is these models become black boxes. After a while, it's not clear who's running whom. Are you running the model? Or is the model running you? The other is you have input fatigue. At some point in time, as you start entering those numbers, it becomes garbage in, garbage out. So here's a message I hope to deliver. As you look at valuations, one of the first things you should try to do is be parsimonious. What do I mean by that? If you can value a company with 3 inputs, don't go looking for 5. If you can value a company with 3 years of forecast, don't do 10. Less is more.